Rich Saperstein, the first quarter is almost in the books, and essentially it was pretty flat, and that's surprising considering you had lower oil and more jobs added to the economy. So what happened?
Well, three things dominated the first quarter and will shape the market for 2015. It's Fed policy, lower oil prices, and the strong dollar. In fact, none of them came together to drive equity prices higher. The permanent income theory of consumers having the benefit from lower oil prices, that won't kick in until the second half of the year. The uncertainty of the Fed raising and the timing really has been a question mark for investors. And finally, the strong dollar is impacting the earnings of multinational corporations.
Let's talk about the Fed for a second, because it always seems to come back to the Fed, whether it be the dollar or the rate hikes. How do you manage money when you know you have to do it through the prism of Janet Yellen?
Well, there's a few things we're looking at. Number one, the Fed will tighten likely September. They want to normalize policy to really put tools back in the shed. We think net-net it's a positive because a strengthening of monetary policy will be a signal to the market that the economy is actually in strong ground. In terms of managing bond portfolios, we're pursuing a barbell approach where we expect the front end to move higher, 1 to 5 years, and then we're actually thinking the long end will move lower or stay at these levels due to global rates being so low.
Now let's talk about first quarter earnings season, which will come up in a few weeks. Do you expect the multinationals to get hit because of that stronger dollar?
Absolutely. So we're already seeing guidance moving lower, and that's rather reflected in the market right now. So our view is that in portfolios, we want to emphasize more small cap equities, more domestic equities, and stay away from the larger multinational names.
What about moving over to Europe? Europe's had a great run because of that weak euro. You piling in there?
So for the last 6 years, clients of HighTower's Treasury Partners have had zero exposure virtually to non-U.S. equities. Our view since the crisis has been that the U.S. will be the global leader recovering first out of the gate. And that's essentially what has happened. So our exposure to non-U.S. equities has been very low. Just recently, we've been adding hedged equity ETFs in the global arena and Europe.
And then finally, what about emerging markets? Because when the U.S. lifts rates, that usually hits them pretty hard.
Absolutely. And there's a trifecta of effects that are going to occur that'll impair EM equity investments. So we have zero exposure there. Primarily, their currencies have declined, and they've consumed a tremendous amount of U.S. dollar denominated debt in the last 10 years. In fact, it's tripled from 1 to 3.25 trillion. So now they have a weaker currency, and many of them that are oil exporters are finding that their receipts or their exports are down because the price of oil is down. So they have lower revenues coming in, they have a weaker currency, and they've got a tremendous amount of debt they have to service in U.S. dollars. That's similar to what happened actually in the late 70s when Volcker raised rates in the 80s. So we expect that could be the next calamity that occurs down the road.
All right, thanks a lot, Rich.
You're welcome.
Thank you for watching The Street.